In this video, I'm going to explain to you one of the major price formation patterns. It's called the head and shoulders pattern. I'm going to be explaining to you how to recognize it, importantly, when to trade it and when not to trade it, as well as looking at how to use entries and stops and price targets with the formation. And finally, I'm going to give you some real-world examples of how this plays out. The head and shoulders pattern is a great reversal pattern, and when combined with fundamentals, it can be very powerful in showing a price prediction.
Hi traders, so I'm going to explain in this video what the head and shoulders pattern is, how to recognize it, when to use it, and probably most importantly when not to use it. So the first thing to say is, as we're looking at these different technical patterns over a course of a number of different videos, just remember this isn't trading advice. The whole idea of this is to give you guys an understanding of this key technical pattern, how to trade it. I'll look at a real world example, but understand that it isn't trading advice. Obviously, I have to start off my video with that. So the pattern that we're looking at is the head and shoulders pattern, a very, very well-known and famous pattern that's often spoken about. You can often hear analysts talking about head and shoulders pattern. So I'm going to explain to you how to use it. So the first thing to realize is that the classical head and shoulders pattern is a reversal pattern. So it's typically used when price is going back in the other direction. So you want to see price having a strong move in one direction, and then after the strong move in one direction, like in this diagram, you can see we have an uptrend, and then the head and shoulders pattern is a key pattern that indicates price is reversing. So the first thing to say, the head and shoulders pattern is a reversal pattern. Now the key way to look at it is it has, as the name suggests, a head and shoulders resemblance. So we have a left shoulder here at point A to B. It has a right shoulder here, E to F and D to E, and it has a head, which is from point C to D. So what you're looking at for a head and shoulders pattern is, first of all, movement in one direction. Secondly, you're looking for the left shoulder and the right shoulder to be approximately the same kind of height. You're looking for a head, which is a peak in between the two shoulders. That is how the classical pattern looks like. A head with a shoulder either side, shoulders as far as possible, roughly the same height, and relatively equally spaced apart. So you don't want one shoulder that's quite close to the head and then another shoulder that's sort of right out over here. You want them to be roughly symmetrical. Now, obviously, real life is never completely and utterly pure. It's not straightforward like the textbooks, but this is a rough idea of what you should be looking at for a head and shoulders pattern. Now, the way to trade the head and shoulders pattern, the technical way, is to trade the trigger. Now, the trigger is the break of the neckline. Now, the neckline is the space from the head down in line with the shoulders, and you're looking for a trend line break of that neckline. So you can see here on the diagram that point F, just above the dotted arrow, that neckline was broken, and that break of the neckline is the trigger for entering the trade. Now, of course, if you had strong fundamental reasons for a currency to be sold, you may not wait for the trigger. You might enter earlier if you had a good fundamental understanding of the instrument that you're trading. However, the technical break is that break of the trend line. Now, the stop placement can be placed just above the breakout shoulder. So, for instance, if the neckline is breaking, you can have a stop above the right shoulder, because if price comes back and penetrates that shoulder, that's a good indication that the pattern was wrong. Now, how do you find a price target? Now, the price target technically is the distance from the head to the neckline extended out once again from the neckline back down. So that should be your minimum price target with a head and shoulders pattern. You're looking from the head to the neckline, and then from the neckline down the same distance as the head and neckline was. So you can see here those two dotted arrows are approximately the same length. So the height of the pattern is also the target for the pattern, and that's how you find that price target pattern. Now, let's look at a real life example that's taking place in the markets now. Now, here we have the euro US dollar currency pair. Now, taking a look at the pair, what we can see is we can see an uptrend, and with the previous uptrend, we see a left shoulder, a head, and a right shoulder. You can see that the left shoulder here and the right shoulder there are approximately the same distance apart. They're roughly the same height. The head is in the middle, protruding out of the top. We're now looking at a price target of the distance from the neckline to the head. That is around 150 points. So we're looking for a move from the neckline break down to around 1.1590. So we're looking for about 150 point break to the downside. That is the price target. Now, a return to this level can also be considered suitable for shorting. So price coming back up to that level can be considered suitable for shorting. Now, this example is because we've had strong, heavy euro longs. The Commitment for Traders report shows record levels of euro longs. It's a very overstretched position, and we've been having a number of equity falls in the markets. If we just head over to looking at the equity futures markets, we can see we've had heavy falls over the last few days during mid-September as the FOMC disappointed from Wednesday week. There wasn't enough stimulus that was projected to come into the markets. The market was disappointed. Equity markets have been overbought, and there is a strong correction underway. And as this strong correction is underway, we've also seen some record dollar short positions unwinding. And just taking a look here at the dollar index, we can see that trend line has broken, and then it's being retested, and the dollar's trying to crash above that dollar index, that level, that 94.25 region. The dollar's trying to gain back into that overall range, which it's sort of broken out of from July of this year. So the dollar index is sometimes known as the anti-euro US dollar pair. So if you put the euro US dollar pair and overlay it on the dollar index, what you see is that when the dollar index falls, the euro US dollar pair rises, and when the dollar index rises, the euro US dollar pair falls. They are inversely correlated. So the fundamental reasons for this euro US dollar short are in play. Dollar strength, equity falls, record euro longs, heavy overstretched US dollar shorts. So there's good reasons for further euro US dollar selling. That's the fundamentals. We have the technicals, and now we have the price target. So there's a very simple example of how to use the head and shoulders pattern in your day-to-day trading. Please do follow me on Twitter. Here's my Twitter handle at Giles Coghlan CCA. Follow me at LinkedIn at Giles Coghlan. You can also email me directly, Giles Coghlan here at HYCM.com. And you can contact me direct for some great programs I've set up to help traders take their trading to the next level. So if you're serious about trading, you want to take your trading to the next level, contact me and I will show you how to go about doing that. Thanks for listening to this video, and if you've enjoyed it, please share it, give me a like, leave a comment and interact with me. Thank you very much for listening. Goodbye.